Hey friends, welcome to today's Singapore Market Digest. I'm Wei from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. OCBC Bank, one of Singapore's largest financial institutions, just released their fourth quarter results. The bank reported a net profit of $1.69 billion for the quarter ended December, which is a 4% increase from $1.62 billion in the same period last year. While this shows growth, it actually fell short of market expectations. Analysts had forecast a profit of around $1.78 billion according to a Bloomberg survey. Let's talk about what this means for shareholders. OCBC has proposed a final dividend of 0.41 per share for the half-year period, which is slightly lower than previous payouts. But here's the good news. They've also recommended a special dividend of 0.16 per share. This is part of their bigger plan to return $2.5 billion of capital to shareholders over the next 2 years through special dividends and share buybacks. For those tracking the stock, OCBC shares closed at 17.60 on Tuesday, down 0.09 or 0.5%. This slight dip might reflect some investor disappointment, with the results coming in below expectations. OCBC operates in a competitive banking landscape in Singapore, alongside DBS and UOB. The banking sector has been dealing with changing interest rate environments, which can impact their net interest margins. Basically the difference between what they earn on loans and what they pay on deposits. While OCBC continues to show profitability, the miss on analyst expectations might raise some questions about growth momentum. From a technical perspective, OCBC's stock has been relatively stable, trading near its historical highs. The current price of $17.60 represents a significant premium to book value, suggesting investors still have confidence in the bank's long-term prospects despite the quarterly miss. The banking sector in Singapore remains robust, with strong capital positions across the major players. OCBC's decision to return capital to shareholders through special dividends and buybacks indicates management's confidence in their capital strength, even if growth might be moderating slightly. Moving on to City Developments Limited, or CDL as it is commonly known, this property giant has had a challenging period, with net profit for the second half ended December 31st coming in at $113.5 million. That's a significant drop of 54.7% from $250.8 million in the same period last year. Revenue also took a hit, falling 23.6% to $1.7 billion compared to $2.2 billion previously. Looking at the full year results, CDL's profit for FY 2024 was $201.3 million, down 36.6% from $317.3 million in the previous year. These numbers paint a picture of the challenges facing Singapore's property sector. CDL's shares ended Tuesday at 5.12, down 0.4% or 0.02. Interestingly, the company called for a trading halt on Wednesday morning pending an announcement. This suggests there might be significant news coming that could impact the stock price. For those not familiar with CDL, they are one of Singapore's largest property developers with a diverse portfolio spanning residential, commercial, hospitality and integrated developments. They operate both locally and internationally, with properties across Asia, Europe and North America. The property market in Singapore has been facing headwinds from cooling measures implemented by the government, higher interest rates affecting buyer sentiment, and increased supply in certain segments. These factors have likely contributed to CDL's challenging results. From a technical analysis standpoint, CDL's stock has been trading in a relatively tight range over recent months. The current price of $5.12 is well below its historical highs, reflecting the ongoing challenges in the property sector. Investors will be closely watching the upcoming announcement to see if it provides any catalyst for a change in direction. When comparing CDL to other property developers in Singapore, like CapitaLand and UOL Group, we're seeing similar pressures across the sector. However, CDL's diversified portfolio and strong balance sheet should provide some resilience as they navigate through this challenging period. Let's turn our attention to Singapore Post, or SingPost, which has some significant corporate action in the works. The postal service provider announced on Wednesday that they'll be holding an extraordinary general meeting, EGM, on March 13th at 3:30 p.m. The purpose? To seek shareholders' approval for the proposed divestment of the Australia business, Freight Management Holdings. This is a major move for SingPost, with the transaction representing an enterprise value of a 1.02 billion, which converts to about $667 million. What's particularly interesting for shareholders is that this divestment is expected to generate a gain of around $289.5 million. That's a substantial windfall that could potentially be returned to shareholders or reinvested in the business. SingPost shares closed flat at 0.1955 on Tuesday before this announcement. Given the significant size of this transaction and the potential gain, investors will be watching closely to see how the market reacts to this news. For those who might not be familiar with SingPost, they started as Singapore's national postal service, but have evolved into a logistics and e-commerce solutions provider. In recent years, they've been expanding internationally, particularly in the e-commerce logistics space, to counter the secular decline in traditional mail volumes. The divestment of the Australia business represents a strategic shift, potentially allowing them to focus on other markets or business segments. The substantial gain from this sale could provide SingPost with additional financial flexibility to pursue other growth opportunities or strengthen their balance sheet. From a technical analysis perspective, SingPost's stock has been relatively range-bound in recent years, trading well below its historical highs from 2015. The current price of $0.50 reflects the challenges the company has faced in transforming its business model. However, this divestment could potentially be a catalyst for a re-rating if the proceeds are deployed effectively. When comparing SingPost to other logistics players in the region, we see similar trends of companies trying to capitalize on e-commerce growth while managing the decline in traditional services. SingPost's strategic moves, including this divestment, will be crucial in determining their competitive position in this evolving landscape. Finally, let's look at Food Empire, a food and beverage company that might not be as well known as the previous companies, but has an interesting story. Food Empire reported that their net profit for the second half ended December 31st fell 3.2% to $28.9 million, down from $29.8 million in the same period the previous year. Despite the slight dip in profits, there's good news on the revenue front. Food Empire saw their revenue increase by 10.4% to $251.1 million, up from $227.5 million. This growth in top-line performance is encouraging, even if it hasn't fully translated to bottom line growth yet. For shareholders, Food Empire has proposed a total dividend of 0.08 tau per share, which consists of a final dividend of 0.06 and a special dividend of 0.0 tau. This dividend announcement suggests management remains confident in the company's financial position despite the slight profit decline. Food Empire shares closed at 9.75 on Tuesday, down 1% or $1 before the announcement. The stock has been a steady performer in recent years, though not without volatility. For those not familiar with Food Empire, they're a global food and beverage company that manufactures and markets products like instant coffee, frozen convenience food, confectionery, and snacks. They have a strong presence in markets across Eastern Europe, Central Asia, and Southeast Asia. One of Food Empire's key markets has been Russia, which has presented both opportunities and challenges given the geopolitical situation in recent years. The company has been working on diversifying its geographical presence to reduce concentration risk. The increase in revenue despite challenging global conditions demonstrates Food Empire's resilience and the strength of their brands in their core markets. The slight decline in profit could be attributed to factors like increased input costs, which have affected many food and beverage companies globally. From a technical analysis perspective, Food Empire's stock has been in a general uptrend over the past few years, though with significant volatility. The current price of 9.75 represents a reasonable valuation given the company's growth profile and dividend yield. When comparing Food Empire to other food and beverage companies in the region, they stand out for their focused geographical strategy and strong brand presence in specific markets. While larger players might have more diversified portfolios, Food Empire's specialized approach has allowed them to build strong market positions in their target regions. Taking a step back to look at the broader Singapore market, we're seeing mixed signals from these four companies that represent different sectors of the economy. OCBC's results show continued profitability in the banking sector, but with some moderation in growth. CDL's significant profit decline highlights the ongoing challenges in the property market. Singpost's strategic divestment represents companies making major moves to reposition themselves for future growth. And Food Empire's revenue growth, despite profit pressure, shows the resilience of consumer businesses with strong brand positions. The Singapore market continues to navigate global uncertainties, including interest rate expectations, geopolitical tensions, and shifting trade patterns. As always, it's important to look beyond the headlines and understand the specific factors driving each company's performance. That wraps up today's Singapore Market Digest. I'm Wei from the Investing Iguana, and I'll see you in the next update. Remember, stay curious and keep learning about the markets.